Good afternoon, everyone. Very happy to have you all here today. Today we will discuss the paper titled "Do Banks Care About ESG? Firm Capital Structure in the Green Era?" We have three groups to present this paper. Group number 2 will present the whole paper, and group number 5 will answer question 1 and 2. And following that, questions 3 and 4 will be answered by group number 6. Each group have 15 minutes, 8 minutes, and 8 minutes separately. If no further questions, let's welcome group number 2 first. Your turn, Rachel. Please share your screen.
Can you see my screen?
Yes, but enlarge it.
Yeah, I know. I will. Wait. How do I enlarge it?
Full screen.
All
Yes.
right, can you see this? Hello?
Okay. Go ahead.
Okay, so today I'm going to present about do banks care about the environment, estimating the greeneum, and implications for bank lending. So in this paper, they basically study like the role of banks in financing the transition to a cleaner economy. So this paper finds that as firms become more ESG focused, they increase their use of bond financing relative to bank borrowing. So the paper matched newly originated loans to existing bonds to show that the loan bond spread increases in the ESG score of the firm, supporting a cost of capital discount channel. So next, I'm going to tell you about the introduction. So nearly 90% of the clients of the world's largest asset manager, BlackRock, rank the environment as a top priority among ESG considerations. Simultaneous to the rise of public market, investor preference for green companies, the CEOs of banks have begun to increasingly emphasize their commitment to sustainable lending practices. However, concerns remain that banks continue to finance dirty corporations. So, for instance, a leading environment group, the Rainforest Action Alliance, indicates that large banks provided $4.6 trillion in financing towards fossil fuel emitting companies between the installment of the Paris Agreement in 2016 and 2021. Next, so why might banks be more inclined to the green firm? So the finding that higher ESG firms use fewer bank loans is not obvious made this question. So first, banks make use of loan covenants and relationship lending to encourage firms to transition away from dirty business practices. For instance, a recent paper finds that banking relationships promote increases in ESG scores by showing that banks are more likely to grant a loan to borrowers with similar ESG scores. And then second, banks have incentives to go green due to the threat of regulatory oversight and potential climate-based capital charges. For instance, the Federal Reserve has been increasingly vocal in recent years about their interest in potentially incorporating climate considerations into stress testing exercises. So, why might banks be less likely to finance greener firms then? So the primary reason is that higher ESG firms may be less risky and thus have less need for bank relationship stability in times of crisis. So with these potential mechanisms in mind, I show that as firms move up the ESG score spectrum, they obtain an increasingly smaller share of their debt financing from banks. And then next, I'm going to talk about the hypothesis development. So in summary, The paper postulates that the primary factor that drives banks to provide financing to dirty companies as public markets pull away relates to the particular nature of bank deposits relative to other savings vehicles available to households. More specifically, consider a household that gains positive utility from financing a green, like basically quote unquote dirty company, and chooses to allocate their savings in either bonds or bank deposits. When a household places their money in a bank deposit, they do so primarily to benefit from the near money qualities of their deposit and are made sleepy, quote unquote, by deposit insurance. In contrast to bank deposits, bonds are assets that derive their value from underlying characteristics of the issue. So that is to say, the price of the bond results from the cash flow, default probability, and ESG characteristics of the borrowing firm, while the price of the bank deposits depend only on the deposit rate and its money-like properties. Accordingly, when a bank provides a loan to a dirty company, the disunitility generated by financing the dirty firm does not correspond to an increased deposit rate demanded from the saver. So as you can see here, these are some of the hypotheses from the paper. And then next, we're going to talk about the data and stylist facts. So in this paper, they draw from several data sources. They start with annual panel of CRSP, composite matched firms beginning in 2011. So they observed that the ESG score coverage increased sustainability over the sample period. There were around 260 matched observations in 2011 to over 1,000 in 2021. Next, they noticed that the log average total revenue decreased substantially throughout the sample due to the increased coverage of smaller firms. Concurrently, they note that an increase in the average bank share due to more smaller firms being included in the sample. And as you can see here, the first results, they redistribute the ESG percentiles into 5 quantiles. They labeled the resulting measure as the ESG bucket of the observation and subsequent tables, with a higher ESG bucket corresponding to a higher ESG score. And then next, I'm going to show you figure 1. So in figure 1, they show the distribution of bank loan reliance for firms in the sample. They observe a U-shaped distribution where many firms use little to no bank financing, while other firms borrow almost entirely for banks. And then in figure 2, they split the sample into 5 ESG score buckets, and they find the average share of bank debt within each bucket. On the x-axis in the ESG bucket, and on the y-axis is the bank debt of share of total debt as measured by composite. And then they also observed that there's a strong decrease in the bank debt share as they move up the ESG score spectrum. The natural response to the figure is that there are many other factors that may be correlated with the ESG scores, which also determine a firm's prosperity to borrow from banks. For instance, it is also the case that average firm size decreases and average traditional credit quality increase as they move up the ESG spectrum. And then this is the empirical results. So as you can see here, there are columns, and I'm going to explain to you about the columns. So column 1 until 2 indicate that firms increase their ESG score. They tend to borrow less from banks. So in column 1, they present the regression, with only the time varying controls and firm and year fixed effects. Even after they include the credit rating fixed effect in column 2, they observe a sustained negative coefficient estimate for the ESG bucket of the firm. In terms of economic significance, they observe that a 1 standard deviation increase in the ESG scores corresponds to a 3 until 4 percentage point decrease in the share of bank loans. In column 3 and 4, they show the coefficient estimates for the log, level of loans, bond respectively. The effect of ESG scores on the stock of bank debt outstanding is negative. In column 4, they observe that increases in ESG scores corresponds to increases in bond financing. In terms of magnitudes, they observe that a 1 standard deviation increases in ESG scores corresponds to an approximately 15 to 20% increase in amount of bond capital outstanding. And then next, I'm going to explain about the instrumental variable approach. So the objective
Hello, Rachel? We cannot hear you now. Hello, Rachel? We cannot hear you now.
Hello.
Yeah,
Can
any
you hear
problem
me now?
will be the connection?
Hello, can you hear me now?
Yeah.
Yeah, I'm sorry. The Wi-Fi was broken earlier.
Yeah, okay. Go ahead.
Okay. All right.
Perfect. Here, right.
Here, right?
Yeah.
All right, I'm gonna. Until which part were I? Okay, so I'll just start again. The objective is to reduce the potential noise in the firm level ESG score estimate. They will consider the ESG scores of firms that compete with the underlying firms as the source of variation in ESG scores. So in this way, they can identify true variation in ESG scores while also reducing reverse causality concerns. So to construct the instrument, they first sort the data into 5 size bins to account for the idea that firms of a similar size are more likely to compete with one another and adopt similar technology. Next, within each size bucket year, they construct an average ESG score for each SIC2. And then next, they remove the ESG score of the underlying firm, which is I, in the average ESG for a given size year as IC1 combination to create an average ESG score of competitors. And then armed with the competitor ESG variable, they then proceed to estimate the first stage to ensure that the inclusion restriction is satisfied. And then as you can see here, in the first column of table 3, they show the first stage results. So intuitively, this estimate denoises the ASG score from potential measurements errors and focuses on variation that is more industry-wide rather than idiosyncratic. In the following 2 columns, they show the OLS and IV and 4 estimates of the main results for the loan share of total debt, respectively. And next, I'm gonna explain about the ESG scores and the loan bond spread. So in this section, they move from firm level data to security level data to study how the ESG qualities of firm affect the price of bonds capital versus loan capital. So first, they collect all new loan issues from DealScan during 2011 to 2020. So they match loans to the firm level panel of financial statement data from Composite and ESG score data from Refinitiv. And the next, they match their data set to secondary market bond yields by the same firm. They include only loan facilities where LIBOR is the base rate. They calculate the loan rate as the all-in spread plus LIBOR. And then in table 4, they show the summary statistics of the complete match sample. So first, note in columns 2 to 3 that they match the issuance, a single syndicated loan facility to multiple bonds for the same firm month observation. In column 4 and 5, they observe that the average loan facility has an interest rate that is lower than the average secondary bond yield. And the next, in column 5 and 6, they observe that the average size of loan facility is greater than the average bond outstanding amount. And lastly, in columns 7 and 8, they note that the average maturity of loan facility is much lower than the average maturity of outstanding bonds. And then next, so the primary econometric test in this section involves studying whether the ESG score of a firm impacts the loan bond yield spread, where they are comparing the yields of a new loan issuance to the yields of existing bonds outstanding that trade in the secondary market. So you basically subtract the average premium in each year month to control for the average loan bond spread in the period, this one, and then calculate the average minute loan bond spread for each bin that is shown in figure 3. So they observe that they move up the ESG spectrum, the spread between loan yields and bond yields increases. This is suggestive evidence that higher ESG firms pay higher rates on their bank loans versus their bond borrowing. So in table 5, they basically showed the resulting estimates. So as you can see in column 1, they estimate the regression only with firm controls and firm and year-month fixed effects. They observe that ESG scores positively relate to the loan bond spread. In column 2, they add controls for the differences in maturities and in sizes between the two debt instruments. In column 3, they subset to only match loan bond pairs. And then next, do low ESG sensitivity savers hold deposits and high ESG sensitivity savers bond holds? So an alternative mechanism that could drive banks to be less sensitive to the ESG qualities of firms is that the average bank depositor is generally less concerned with ESG considerations, while bondholders are a different type of more informed investors. To explore the hypothesis, they calculate the total bank deposits held by different net worth percentiles by summing the value of transaction accounts and certificates of deposits. So basically in the left panel, they observe that the majority of financial assets are unsurprisingly held by higher net worth households. In the right panel, they observe similarity that the major of bank deposits are held by those same higher net worth percentiles. It addresses a potential concern that the marginal provider of bank deposits exhibits a higher ESG type sensitivity when compared to the marginal provider of bond financing. And then next, how sensitive are bank depositors to the ESG quality of their bank? So in this section, they present complementary evidence of the information and sensitivity of bank deposits. They use call report data to study whether increases in the ESG scores at a bank correspond to increasing deposit flows. Next, they match the bank deposit data to ESG scores at the annual level, leading to an unbalanced panel of 180 unique banks from 2011 to 2021. So in table 6, they show the resulting coefficient estimates. They show the regression in terms of the level of flock deposits in the first 2 columns and in growth rates in the second 2 columns. They observe a consistently null effect of ESG scores on deposit flows, supporting the main hypothesis of the paper regarding the ESG sensitivity of bank deposits. And then next, we're going to move to conclusion. So in conclusion, they show that as firms adopt more sustainable practices, they tend to increase their relative use of bonds substantially when compared to bank loans. ESG score increases translate to lower cost of capital for bonds relative to loans. The nature of bank funding relative to bond investment account for the suggestive evidence of substitutions. Bank depositors are sleepy, and thus the majority of bank financing is unconcerned with the exact asset distribution. Thank you.
Perfect. Very nice. Excellent.
Thank you.
Yeah. Questions about the presentation?